Question 1 is about adjusting entry, and so the April, May really doesn't matter as long as there's adjusting entries, right? Fiscal year end can be April or December. And what is the effect on this adjusting entry, which is about salary expense? So we're gonna recognize that we actually owe our employees that much amount of salary. So on one hand, we're gonna debit salary expense. This will show up in income statement. On the other side, credit side, we are establishing a liability, which is salaries payable. And expense will eventually goes to stockholders' equity by reducing it, right? Reducing the retained earnings. The correct answer is B, assets are not affected. Liability increases because of the payable, and stockholders' equity decreases. Remember expand the accounting equation for expense and stockholders' equity. Right, this is the correct journal entry. Question 2, total stockholders' equity for Dearborn Inc. at the beginning and end of 2016 is $20,000 and $25,000. So there's a change, right? So we have the stockholders' equity information, and then we have the asset information for the second line. And then the third sentence is about liabilities. And question is, how much were total assets at the end of 2016. So two different times. One is the beginning of 2016 and then the end of 2016. So we have asset, liability, and stockholders' equity. Pretty much we're gonna figure out what's in it and then find out what's missing, right? So let's fill in the blank first. For beginning of 2016, do we know the asset? Yes, it's 32,000 here, right? Let me switch to a thinner pen. And then for liability at the beginning, which is, we don't know, we only know that if liability increased by 9,000, right? Do we know the beginning balance of liability? Okay, so let's say this is a question mark. And beginning of equity is 20,000, right? This one. Before we jump to the end of 2016, we can solve the beginning of liability, which is 32 minus 20, right? And then we get 12,000, using asset minus equity. And then, so we know this one is 12,000, and according to the question, it increases by 9,000, so that we know the ending balance of the liability, which is this one, which is 12,000 plus 9,000, and that is 21. Let's use a K here, right? That's how we get this one. And then, okay, let's figure out the rest for the end of 2016. Equity is 25K. So how much is total asset at the end of 2016, which is 21 here, right? We are asked about total asset here. So which is 21 plus 25, that is 46. So correct answer is D. Question 3. In the end of December the 1st of 2016, the company received $2,400 in advance for an agreement to care with equal monthly effort for a client's office plans during the month of December, January, and February. So this $2,400 is for 3 months, and it says it's equal effort. So allocating it for the 3 months, each month is 800, right? 800 per month. Assuming the adjusting entry have been recorded for 2016. Oh, so it's already recorded. Now, at the end of the year, how much do we have? So, correct answer is B. We recognize 800 revenue under accrual accounting, or 2,400 revenue under cash-based accounting. Okay, so this is the question on accrual basis versus cash basis, and this is what we covered, in the first half of the semester. Cash basis is easier. Whenever you receive cash, that's what we count for it. So we received 2,400 lump sum in 2016. That's why this is 2,400. So then we can rule out C, right? The 16, and then for accrual basis, we can look at like how much do we record journal entry, because our journal entry is under GAAP. GAAP uses accrual basis, and we have pretty sure how to do the journal entry, right? We recognize 800 revenue for the month of December, while we still have 2 months that to be recognized next year. So only 800 out of the 24. So 800 here. This is accrual equals what we do the journal entries. All right. Question 4, the next one. Which of the following transaction would increase total asset? So whenever you see this one, right, we will analyze each one and see what are the accounts that are affected, and what category are these accounts belonging to, right? So the first one, borrow cash on a note payable. Well, the account names are showing up here already. Cash is an asset. Notes payable is a liability. Now we borrow cash, so we have more cash, more total assets. So number 1 should be it. And then the second one, provided service on account. On account, whenever you see this one, that means we haven't received anything, right? We provide service. In return, we should receive cash. But now it's on account. So what is the other account instead of cash? Accounts receivable. Is it an asset?
Yes.
Yes, it is. Asset, right? Accounts receivable. So we know service revenue is one account. The other one is accounts receivable, which is also an asset. Both will increase after this second transaction. So increase total asset as well. Question?
Yeah. Why is 3 not an option?
3 not an option?
Because you're receiving cash from the customer.
This one?
Yes.
Okay, here we go. You have answer?
Yeah.
Go ahead.
Oh, because it's receivable, so you already have that asset.
Yes.
So when you receive the cash, it just cancels out the receivable.
Right.
So what he said is we have 2 accounts for transaction 3. One is cash. The other is accounts receivable, right? Both are assets. So we are switching amounts within assets. So the total net amount of asset would not change. That's why it would not increase assets. So not only do we need to identify whether these accounts are assets, we also need to consider how many accounts of assets in each transaction. So 1 to no 3, right? 2, receive a utility bill that will be paid later. You need to pay, and you haven't paid. Nothing is asset. Utility bill, now that you receive a bill, you need to establish this expense. And then you haven't paid it, you have a liability. So liability and expense, which is in income statement, so no asset. Correct answer is 1 and 2. Number 5, on September the 1st, 2016, Cooking and with Tara, a company obviously, sold 600 one-year magazine subscription for 81 each. So the total amount should be something like 600 times 81, right? And subscription starts immediately. The total amount received was recorded as deferred or unearned subscription revenue, which of the following accounts and amount will appear on the unadjusted trial balance at December 31st. So let's see, in order in the sequence of time, what happened before we adjusted, right, unadjusted. So September the 1st, when we sold the magazine, so we receive a lot of cash. But then on the other hand, as the question say, we will do it. We will record the amount on this deferred subscription, which is a liability or asset. Deferred revenue. liability is a liability. So an increase in the liability will be on the debit side or credit side. Credit. So I'm doing it on the right-hand side. And then I should record, this is September the 1st, I should record 600 times 81, which according to the correct answer, the amount should be 48,600, right? Do I do anything during, after it, and then before December 31st? Seems like we haven't done anything. There's no, a timeline or specific dates in the question. So this is what we have now, right? And this is what we have before adjustment. So the unadjusted trial balance on December 31st, unadjusted, would be just this amount, right? And let's do the adjustment. So during the adjustment, now in the end of the year, we need to look back and then see how much revenue can we recognize. And it's gonna be September, October, November, December, 4 months of revenue. So 4 months, we should do 4 months out of 12 months, because it's a 1-year magazine subscription, and times the total amount. So whatever we get here, the amount of X, we should subtract it from the deferred subscription revenue account, subtract it here, right? Debit side means decrease. And then on the other hand, we would do credit the revenue of the exact same amount. Like debit, defer, and then credit revenue, this is what we do for adjustment. And then the question is unadjusted. So it's everything above, which is only one line. This is the first one, right? So make sure about reading the question right. Question 6 is about bad debts using allowance method, all right? On June the 1st, there is a write-off. And then based on this estimation, we'll never pay any portion of balance in his account. What effect will this write-off have on the balance sheet at the time of write-off? So now I list 2 accounts here. Both of them are asset accounts. This is account receivable, right? Because every time we see allowance method, we are doing it for account receivable. And then this is the counter account. Contra asset account for allowance for doubtful. Contra, that means an increase will be on the credit side. Now, the hint is write-off will happen between these 2. So how should I do the write-off? Debit what and credit what? Write-off means, what we estimated before that something bad will happen actually happened. So our reserve can reduce. This is exactly our reserve. So a write-off would be debiting here, 2,500, right, 2,500. And then credit 2,500 here. Remember the places. Doubtful. Yes, exactly. Right, this is the old name. It should be allowance for uncollectible account. Thank you. Uncollectible. The previous version of the textbook used doubtful, so I keep using it, sorry. And as I said before, these 2 are asset accounts. So it's basically switching amounts within assets. So the net effect on the accounting equation should be no effect, right? A equals L plus stockholders' equity. No effect, no effect, no effect anywhere. So it's B. Right, I hope you guys, when you do final exam, this one should take you 1 minute. Once you identify write-off, the word write-off, and then the first thing you should think of is no effect. This is the whole point of creating this allowance for uncollectible accounts, is that we want to minimize the impact of this shock that we cannot estimate before. It's not controlled by our company. We want to minimize the impact as small as possible. So here, no effect, good, that's what we want. Sorry. Okay. That's a
So, like, whenever there's a write-off, there will always be no effect.
no effect. That's right.
Always, whenever there's a
Yes, no effect on the accounting equation. But if the question asks what is the effect on allowance for uncollectible account, well, for a single account, there is effect, right? Or for account receivable, there is effect. But on the accounting equation, no effect. Question 7. There's a credit sales of which 600,000 is not yet due. 100,000 is past due up to 180 days. When you read to this point, you know this is, we're gonna calculate using the aging method, right? Calculate the allowance. And then 50,000 past due of more than 180 days. Under the aging method, the company expects that it will not collect 1% of the not yet due, and then 10% of the medium one, middle one, and then 20% of the longest one. Now, what's the question? The allowance account has a debit balance of 1,000 before adjustment. After adjustment for bad debt expense, what is the ending balance of the allowance account? Well, this is a calculation question and it's related to the previous question. Like last time, last question, we talked about write-off, which is between these two accounts, right? And then when we do adjustment, this is happening in the end of the fiscal year, we will gonna estimate what should I put on the bad debt expense. This is also an adjustment, right? So it happens in the end of the year related to expense. Remember the whole calculation. Again, this is doubtful, right? Uncollectible in your textbook. The first thing we can do is, we have 750, and then we know we're going to allocate 1%, and then the second one is 600,000. We're going to allocate 10%, and we know there is the last one, 100,000, and then 20%. And then we can calculate each of it, and then when we sum them up, we got an amount, right, according to the hint. Where did I? Oh, okay, totally. Sorry. Well, but you can see here, this is the correct one, right? 100 and then 50. Then I got the 26,000. But where should I put it? What is it? It should be after the adjustment. What is the ending balance of our allowance account? So this one, when I calculate it, it is. I should put it here in the allowance of uncollectible account ending balance after everything. This is our goal. We want to do it. We want to adjust our accounts so that in the end, the allowance account has a credit balance of 26,000. Notice that this is a contra asset account, so the balance will be on the opposite of what the usual asset account is, which is debit. So this one will be on the credit side. Now, how do I adjust for it? And then the second hint here is that there's actually a debit balance of 1,000 before adjustment. So I will have a 1,000 here, right? Debit side. What should I do so that I can have a 26 in the end? Go ahead. Yes.
You have 27,000 on the credit side.
Yes, I should put something here, right? 27,000. Well, that would be easy to say if we treat this one as the main calculation side. So it's minus 1,000 plus an x will equal 26,000, and in the end, this is a 27,000. But what is it? How do I do journal entry to make it like this? I would, credit 27,000 for the allowance account, and then on the right side is debit bad debt expense for the exact same amount. So to solve it, we know this, a different color, so that we have a 27,000 here, and then we do this. if the question asks us, what is the bad debt expense, we would do this. But what is the question? The question asks, what is the ending balance of allowance account? So it's actually 26,000, right? This is the whole process. But make sure what the question is about. This is a past exam, and then a lot of students actually choose C. So pay attention to it. Make sure you know what you are calculating. And then once you put it here, double check the question. All right. So we have talked about this type of question in the previous review. The key is first calculate this one from all the percentage. And then the second step is to back out what is here. So it's from the bottom up. Question 7, let's move to inventory. Let me enlarge it a little bit first. Is March 23 the last one? Okay, good. So, sold 2,300 units of inventory during the month. Ending inventory, assuming a weighted average cost, would be, so the question is on ending inventory, and then we can back out, how much number is left, and then what is the unit cost, and then we multiply them together, we got the total value of the ending inventory. So we need to first calculate the weighted average unit cost. So the denominator, the numerator would be the total cost of available for sale, and then the denominator is the number of units, right? So we have, do I miss anything here? Is my question? No? Okay, stop inking. Yes, here. Interesting. Can you tell me the number?
Yes. 720 for the first.
720. Thank you.
725. And then 30 and then 35. I mean, with 720. Sorry.
And the last one is 725. Oh, so it's actually increasing, right?
Yes.
All right. Okay. So this is the unit cost, and we know we gotta first calculate the cost of goods available for sale, which is using the first one, right? Is this plus 600 times 725 plus 800 times 730 plus 600 times 735. What we got in the end is the total cost of goods available for sale. Make sure that the unit here is in dollar sign. And then we divide it by the total number available for sale, which we sum these number of units, sum them up together, and then that will be our denominator. In the end, we will calculate, this is the weighted average unit cost. And then now we need to calculate the ending inventory, which is the total amount minus 2,300. That is what is left, which is how much? 3,000 in total minus 23,000. This is the number not sold. And then times the weighted unit cost that we got. Let's see in my notes. Unit cost should be 7,267. This is the first one I calculated, and then I will times it with what we have here. So this 3,000 is the 1,000 plus 600 plus 800 plus is the sum of this, right? The sum of this minus 2,300, which are sold, equals the number of goods that are not sold, right? Number of goods not sold, and then we times the unit cost we calculated here. Pardon me?
Are you got the 7.2?
7,267. use the following formula. So I first calculate. Let's go over it, see if I have the hint here. Okay, I have the hint here. I do have it here. All right, so first I need to calculate the total cost of goods available for sale, which is in dollar sign. And then I would do 1,000 times the 7.2 plus the total of the second one, total of the third one, fourth one. When I sum them up, is the numerator here. So because it's in dollar sign. And then denominator would be the total number. Number means the number of units. I sum this column up. This gives me 3,000. So I use whatever I got here, divided by 3,000, I got 7.267. This is the unit cost under the weighting average method. And then now I have the how much it's value at each unit. I need to find out the number of that are not sold, which is using the 3,000 subtracted by 2,300, which is 700 times 7.267. And correct answer is A. I think these two formulas are quite helpful, and then I actually got it from the slides. Question 9 is about LIFO and FIFO. What are the differences? So it gives us A, B, C, D different assumptions. One is in a decreasing cost, and the other is in rising costs. So one method to do it is to assume a situation where you have two inventory purchases. The first one, right, because this is say the correct answer is C now. Now it's on the rising cost assumption. So say date 1. I have units. I purchased 3 units. Each unit, my unit price is $1. And on day 2, I still purchased 3 units. And now it's a rising cost. So when I purchase later, my cost is higher, 2 units. And then I just assume, say I have sold, say 5 units. And I would calculate, say, what is my net income. So net income probably equals revenue minus the costs. So I need to know the costs, right? So I need to know, for the 5 units I sold, what are the costs under LIFO and under FIFO? And obviously under LIFO, last in, first out, so I will use up all the 3. And then 2 here, so 3 times 2 plus 3 times, left is 2 times 1. 3 and 2 means the total 5 units I sold. So my COGS will be 6 plus 2 is 8 units. And then this is LIFO. Under FIFO, it's the opposite, 3 times 1 plus 2 times 2. Obviously, LIFO is cheaper, right? 7. So a cheaper COGS leads to a higher net income. And then higher net income would be on LIFO. So on FIFO, sorry. On FIFO, higher net income. So LIFO is a lower net income. Well, that's how you do it if you cannot remember it. But now that we have time, we still have time before the final. And if you are under Professor Deng's, online courses, under the slides, you have a summary of all these differences. So this is from the slides. Let me enlarge it. And I think the question is very likely to be asked, to show up in the question. So let me erase this one. I think it's very highly possible that this question will show up. And if you have time, you should give yourself an example, just like what we did, and then solve basically all these possible things or counts that will be affected by LIFO, FIFO, different methods. Cost of goods sold is the easiest, as what we pick there. And then income before income taxes, net income, all are function of this cost of goods sold, right? You need to subtract the cost of goods sold from your total revenue earned. So higher cost of goods sold will have the opposite effect on this one. Inventory balances also, right? If you have a higher cost, whatever left should be lower. So as you see, right, you see a higher here and then all are lower. Same for the FIFO one. So it's actually not very hard to memorize. You should only memorize the cost, and then all the rest that will show up is the opposite of the COGS, right? So I'll go back and memorize it. I think it's very useful. And mind you that the assumption is under rising cost, right, in the bottom. Rising prices. That means the inventory prices is increasing along the table. Question how many? Question 10 is on the long-term assets. Research and development costs should be, correct answer is A, expensed in the period occurred. So when we say expense, that we mean that we will put it on income statement as an expense when we do journal entry. What is the alternative? The alternative is to do what we say capitalize. When we say capitalize, that means we put it in asset. Asset will increases, the company's value, right? The size of the company. So two things, and then it's actually this sentence here. We expense in the income statement most of the cost of internally developed intangible assets as we incur, and then this increases. For example, this includes the R&D. This is from your textbook, page 328. So once you read through it, you'll find these keywords here. So it should be expensed. And it's not when they are determined to be unsuccessful. When no matter it is successful or not, it should be expensed in the period once you incur this cost. Question 11, double declining balance method. Which item is no need to compute depreciation for the first year? All right, so all we need to do is to go back to the formula of double declining method. Again, this is from your slides. Double declining, this row. All right, so it's okay, here is the key thing. Accelerated method doubles depreciation rate used in the straight line method, and also excludes residual value from calculation. And the question here is, which item is not needed when we calculate depreciation in double declining? So it will be residual value, right? It's just in your slides. And basically how we do it, I believe later on we'll have a question on it. So when we see it, we'll do the calculation. All right. Question 12. We purchased this equipment for $85,000 on January the 1st, and then we sold it on July the 1st for $30,000. All right. The company uses straight line method for computing depreciation, assuming a 5-year useful life, no salvage value. When recording the sale, the company should record a debit to the accumulated depreciation for. So here I list all the accounts possible that are related to this equipment. When we first buy it, right, we have the purchase cost. This is what we call the book value in a gross term. And this is, for the historical cost, right? All these are the name of, referring to the amount we pay to purchase the equipment. And then we also have the depreciation alongside with the equipment. Whenever we use it, in the end of the year, we should do depreciation. And this is a contra asset account. Question, if you don't see an accumulated, you just see depreciation in the account name. What account is it? Is it an expense account or asset account? Without accumulated, just depreciation. expense account. So it's quite tricky. So when you see depreciation alone, it's an expense account. And then accumulated depreciation, as you see, is the accumulated for the past few years that you have depreciation, and it's contra asset account. And when you see the equipment net book value, is this one minus the accumulated depreciation, right? It's the net. But also we have the gain and loss when we sell it. So when we sell this, let's say after we sell this equipment, there should be no accounts related to this equipment anymore, right? So when we do the selling, the journal entry related to the selling should erase all these two accounts. We should remove it to 0. That means whichever happens here, say this is 1 million in the accumulated depreciation, we should do a contra one to erase the 1 million, right? If it is on the debit side, we will do a journal entry of crediting it to make it 0. Now here is basically what it asks. Now the question say when we record the sale, the company should record a debit to the accumulated depreciation for how much? In other words, it asks us, how much is the credit balance that is sitting on accumulated depreciation before we sell it, right? That's basically the question. And of course, it's a contra asset account, right? Increase in normal asset account is debit. So this one is on the credit side. That's why we need to debit it to erase it. Okay, so in the end, it asks us how much is in the accumulated depreciation by July the 1st. It's January to July, so how many months? 6 months, half of the year. And then the total 85,000 is supposed to be used for 5 years, and now we use for half of the year. So no salvage value, right? So 85K, no salvage value. Using the formula, this is for 5 years. This is the annual depreciation amount, 17K. And now only half year has passed. 3.5.
This is true.
Oh, thank you.
It goes from 16 to 19, 2016 to 2019.
Oh, thank you. Thank you. So it's 3.5 times 17. Okay. I guess the correct answer would be this one then. Right, so it's gonna be, right, the first one, 17K here, 17K here, 17K here, and then this is 2016, 2017, 18, and then 19. The other way. Well, you know what I mean. Like this, and then the total number would be 59 and 500K.
So when we see a debit to accumulated depreciation, it basically means accumulated depreciation as an account decreases.
That's right.
So we're taking it out.
Yes.
But a credit to the accumulated depreciation would mean accumulated depreciation account increases.
That's right.
Right. Okay.
Yes. Do you want to see the complete journal entry? Right. So right, we calculated this amount just now, and we know when we purchased the equipment, it was worth 85,000. The first thing we need to do is to erase these two accounts. Well, equipment is an asset, normal asset, so to erase it, we need to credit it, right? Accumulated depreciation contra asset, so we need to debit it. And what else? We receive cash for 30,000. Now, before we decide whether it's a gain or loss, we calculate the net. On the debit side, there's 30, 59 is already 89. 500 is greater than 85,000, right? So we have more debit than credit. Well, that means we need something on the credit side, and that's the first step. We need to decide, what should I put the difference here, And the second thing we need to do is to decide whether should I write a gain here or a sale here. We can decide it on two things. Whenever we have a gain, right, like revenue is a gain, right? And then revenue, we always credit it. So now that you see we need to credit something, it must be a gain because you know, revenue. We always credit our revenue. We never debit revenue. On the other hand, you also can do it by deciding this. Right, as I said before, equipment and accumulated depreciation, the net of it, I'll come to you. The net of it is the net value of the equipment. And that would be 85 minus 59,500. That is 25,500. It's less than what we paid, what we received. So we sell it for a higher price than it is valued in my book. So it's a gain. And then we also put it as the credit. Question?
Yeah, you just answered it.
Thank you. Question 13. New equipment, purchased it for 60,000, pay cash for it. Other costs associated with the equipment were, we have a transportation cost, a sales tax, and then an installation cost. And you know, how much should I pay? Should I record as the cost of the equipment? Well, it's actually a pretty easy rule. According to your book, page 325, we record a long-term asset at its cost plus, but cost is the previous one, the cash we pay, right? Plus all expenditures necessary to get the assets ready to use. Well, we have to pay sales tax in order to finish the purchase. What else is in it? And we also need to pay the transportation cost in order to, you know, let it use in my warehouse, right? And then the third one, we have to install it, of course. So all the threes are necessary. So the key word to decide whether we should include it in the cost is whether it's a necessary thing to make it work. So if you say, I think it's too dull, it's only one color, let me paint it with a colorful, say, teddy bear or, you know, any characteristics, it would not be necessary, you know, as long as it's working. So that painting fee would not be included, right? That's the determinants. Oh, you also have an Olive Garden example on the next page of the textbook. Question 14, which of the following statement is false? Correct answer is C, accumulated depreciation represents a growing amount of cash to be used to replace the existing asset. We've never involved the concept of cash in the accumulated depreciation, right? Whenever we record accumulated depreciation, the counter account will be depreciation. So it's a non-cash item. Right, so that's the main thing. So actually B is, you know, once you think B is right, C must be wrong. Any question on this one? Question 15, a loss is recorded on the sale of planned asset when so this is what we calculated before. Now that this book value would be the net value of you know, the cost we have, and then the accumulated depreciation. Right? Remember the previous journal entry we compare, right? This book value is the cost of the equipment minus accumulated depreciation. And then we compare this one with the cash we receive. If it is smaller as last time, we have a gain. If it is greater, that means, you know, I sell it for a price lower than what we value in our book. That means it's a loss.
Question 14 about accumulated depreciation.
Here?
How come it wouldn't be question Answer D. Since accumulated depreciation is the portion of planned asset cost that has been recorded previously as an expense, is it like? Doesn't it sound wrong? Since accumulated depreciation, I found an answer in the book that it says accumulated depreciation represents recording depreciation as an expense as we go, not the other way around. And the answer D feels like it's the other way around.
Let me think about it. Accumulated depreciation is that portion of the planned assets cost that have been recorded previously as an expense.
We're trying to record expense. It hasn't been recorded before, right? In accumulated depreciation. That's what accumulated depreciation represents.
I think it's already recorded, right? The first instinct occurred to me is that it's not an expense. Accumulated depreciation is a counter asset item, right? And expense would be just depreciation that account. It's not accumulated depreciation. Sayon, what do you think on choice D? Do you have a different view? So for me, I think the reason it's false is, its expense always refers to depreciation in the income statement, while here accumulated depreciation is a counter asset account. But I'm not 100% sure. What do you think? And the answer is C, and the choice D is what we are confused now. Planned assets costs that have been recorded previously as an expense. That's what I think. Okay.
I think it's because depreciation expenses from year to year, and then accumulated is the sum of all of those.
Yeah.
Later on.
Yeah.
Accumulated depreciation is the total depreciation expense.
Oh, it's false.
So we need the false answer.
Thank you. Thank you. So yes. So previously, all of the years, each year is gonna be one portion and allocated to expense.
Allocated to expense.
Right. And previously, that means including all the past. So this is a total sum of amount. So it should be a correct answer. I also, yes. Thank you. I was thinking. Thank you. Thank you. It's a correct answer because if there's instead of previously, it's like last year or something that may not be complete, but we need a false answer. Oh, thank you. Almost tricked. Question 16. So company purchased a machine for $200,000 on April the 1st. Estimated service life is 10 years. Residual value is $20,000. When you read that, you're gonna come up with the formulas. What is the depreciation expense for 2016 using double declining balance depreciation? First of all, let's notice that it's not 12 months for 2016, right? We only have it starting on April the 1st. So it's from April to December. There are only 9 months out of it. So, this fraction will be showing up in your calculation. Right, 9 months out of 12 years. And then, so what is the double declining balance depreciation calculation? We have a 200,000, and then we know it's gonna be 10 years. So we will divide it by 10, but then we're gonna sum it by 2. And then now, let's take the 9 months into account, right? So note that the 20,000 residual value will not show up in the calculation because of this is double declining method. So the cost, 200,000 times 1 over the number of years you're gonna use. And then this is a double declining, so we need to times 2. And then times the fraction of the year, of the months, sorry. Correct answer is 30,000. 17, what is the book value of the equipment at the end of 2017 if it uses straight line depreciation? So book value of the equipment, again, is going to be the cost minus accumulated depreciation. So we cost is set is 200,000 according to the question. Now we only need to calculate, by the end of 2017, what is accumulated depreciation account. And then it is under straight line depreciation. So in 2016, straight line depreciation which gives us, now we need to take care of this residual value, right? And then we divide it by 10. Also think about the fraction, only 9 months in 2016. Now there is no times 2 because it's straight line. This is the first year. And then another year, it's going to be the same. But instead of times 9 divided by 12, that's all we need to do. So it's 18,000. These are the two depreciation for 2 years. And on the accumulated depreciation account, these two will stay, right? Go ahead.
Is it okay to think about it? That what helps me is I do from April 1st, 2016 to April 1st, 2017. I
Sure.
do that year,
Sure.
and then I do the other half.
For the calculation purpose, yes. But for a journal entry purpose, we usually do it on December 31st. So, but it's basically the same for the calculation, right? Remember that accumulated depreciation account is on the credit side. So we have this on 2016. And then we put this also on the credit side on 2017. This is the depreciation account in the expense, DEP. So the sum, the total is summing these two up. So we have this here, right? And then the net 200,000 minus the accumulated depreciation, we got choice C. Go back down here. Yes, I just want to show you what do we put these two in the T accounts. Now we look at in the end of by the end of accounting by the end of 2017, what is the ending balance of accumulated depreciation? It should be the sum of these two, right? One is in 2016, one is 2017. So the sum of it, 31,500, is the total ending balance of accumulated depreciation. And now we need to get the question asks us, what is the book value of the equipment? Going back to the, our formula, book value equals the cost minus accumulated depreciation. We just got this 31,500. Cost never change once we buy it, so it's 200,000.
So we always account for the portion of the first year if it's not a full year, right?
That's right. Yeah, that's why I answer his question as calculation-wise it's the same, but we need to do journal entries, so that's the time point. Question 18, what is goodwill? According to your textbook, again, page 330, correct answer is may be recorded when a company purchases another business. So here it says in bold, it is recorded only when one company acquires another company. So it will not show up when you do other business transaction. You not say like I sell a lot of products this year. Can I record goodwill? No, it's always showing up in the M&A. So basically, it means when I pay a certain amount to acquire another company, but when I check the company's book, acquirer's book, and I found that the money I pay is way higher than what it is worth according to the book. So the difference, how do I record it? Now that I incorporate everything from their book to combine it to our book, right? The difference I should put is in goodwill as an asset. All right, let's switch chapter to liabilities. Now, question 19 is about our short-term liabilities, and we actually have exercises on it in the previous half of the semester. It borrows $500,000 on November the 1st, and this is a 12-month note. Interest is payable in full at maturity on November 31st next year. In connection of this note, it should report interest payable at December 31st with the amount of, for how many months? We have November, December, 2 months in 2016. So we only need to figure out how much interest is for 2 months, right? So this is principal is 500,000. Annual interest is 6%. This is annual rate. So after this calculation, this should be a 12-month total interest. Now, from November to December 31st, there is only 2 months. 2 months divided by 12, so calculated as 5,000. This should be easy, right? Question 20. A supplier borrowed 80,000 cash on October the 1st to fund a geological survey. This supplier issue a 9-month 12% note payable with principal and interest payable at maturity on June 30th, 2017. Now, its adjusting entries only recorded on December 31st. So they ask about the June 30th, 2017, the ending journal entry. Remember in the practice midterm, we also did the same thing, right? We talk about the journal entries for the first date when we borrow money, and then on adjusting entries, and then at maturity, how much should we pay? Now let's quickly review all of them. So October the 1st is when we first borrow money. Now we as the, let's say, what do we stand? Here we are the borrower, right? We borrow money. Okay, so we are the borrower. We should establish the liabilities. We borrow money, so we have cash, 80,000. So we need to debit cash because we have money. On the other hand, we have a note payable. It's a note. Note payable for the same amount. Nothing fancy for the first date. And then we need to adjust entry. Let me write it here. How many months should we adjust? October, November, December, 3 months. So again, like last time, calculate the total interest for 3 months. Principal is 80,000. Annual interest rate is 12%. And we are talking about 3 months out of the whole year. The answer should be 2,400. So we need to do something on this 2,400. What is it? Interest expense on debit side. Expense is always debited. Credit interest payable, 2,400. Now, here is what the question asks, and here is the last one, June 30th. That's what we pay everything. We pay principal, we pay the total interest. Principal, 80,000, no question. Total interest would be, this is a 9-month note. So total interest would be 12, 9-month note, please. So it's 9 over 12. These are the total. Let's quickly calculate it. How much does it? This is 349, right? So 8,972,100, I guess. So the total of these is 8,7,200. This is the total cash we paid. The first one is the principal. The second one is the 9 months interest. Right? We still use the formula, and total is 87,200. Debit cash for that much, because we are, sorry, credit cash. In the meantime, we need to erase whatever accounts related to this debt because we are paying it off. First one is our 80,000, but which we put it in the note payable before. Second one is this, we're gonna do something on whatever left here. This is previous year, right, last year. Expense is an income statement account. Income statement will all go, start from 0. So this 2,400 for expense will not last for the next year. But payable is an liability account on the balance sheet. Balance sheet is a stock, so it will keep going. It will carry forward. So we still have a 2,400 sitting in my interest payable. We need to erase it. So debit interest payable for 2,400. The last one is the difference between these two. So we still have, how much? 4,800. Thank you. 24. And we will put it where? Expense. We haven't done anything for the left 6 months. And for a routine, this interest, it's an expense we occurred by borrowing the money. So eventually it will go to expense accounts. And this is the whole set of journal entries we do for the 3 different dates related to this 9-month note. And now this is what we do for the last date, and then going back to the question and see what it asks. Just pick the one that matches what it has here. So it's gonna be 2,400. Question C is this one, right? C here. Question? Move on. Question 21. Young company is involved in a lawsuit. The liability that would arise as a result of this lawsuit should be recorded on the books if the probability of it owing money as a result of the lawsuit. So a question is, what is the probability? A, probability remote, and then amount is reasonably estimatable, probable, and the amount of reasonably estimatable. So it's like a different degree of probability, right? Going back to the, it's a concept question. So let's go back, and this is something we have to memorize. There's no choice. Slide says, record the liability if future events is probable. So keyword probable. The amount, so dollar sign, can be reasonably estimatable. So you have 2 words for the amount: reasonably estimatable, estimated, and then this probable. So 2 conditions. And remember these 3 keywords: probable, reasonably estimated. And then things that can match is B. B is the choice. Yeah. So there will be some conceptual questions, huh? Question 22. When bonds are issued at a discount and the effective interest rate is used for amortization, about the second after end, that part just reminds you that we are using a table, the amortization table. At each interest payment date, the interest expense will increase or decrease or remains the same. Well, I would think nothing can beat a visualized table. So I go to your textbook, page 430, right? We found the at the discount situation, what means at the discount, the carrying value at first is lower than the the principal, the par. So it's 100,093, so it's at a discount. And then the question asked about interest expense, which is column 3. Look at column 3. 3728, 3737, so it's increasing, right? Increasing 39.62, 39.81. So the whole column is increasing. Choice A is the answer. Well, these are some of the features of the table that you have to memorize. How about at the premium? What would be the table like? We have a next question about it. But do make sure you know how to calculate each of these two columns, right? How do we calculate it? Using carrying value times market rate, right? What is the carrying value? Is it 93? No, it's the previous one, the previous row. So, make sure you know how these numbers are from. Question 23. There are two bonds, but they are both issued by the same company. Each of the bonds has a face value of 100,000, and each matures in 10 years. So the length and the principals are the same. Only difference is the face interest rate. A market interest rate is 7%. So one is willing to offer more than the other, and both of them are comparable to the 7%. That means, investors are quite willing to invest in your company. It's not like, bad deal. Which of the following is correct? Well, it will sell more for the higher interest rate one. This is quite straightforward, right? Nothing fancy on this question. Question 24. When bonds are issued at a premium and the effective interest rate used for amortization at each subsequent interest payment date, the cash paid. Now we are comparing, the cash column with the interest expense column. Now this is an expense, and I know on the next question, question 25th, you have a table. Right? This is the bond that. Why is it always a little bit smaller? Let me. I see. How can I let it show everything? This is weird. No, I want to use this table to answer the previous question. Sorry about that. What happened to this one? Whenever I want to, it kind of skip the, but you have the question at hand, right? Sorry, thank you. So do you know, how can we decide that this table is issued at a premium? Anybody can answer?
The carrying value is greater than the face value.
That's great. The carrying value at the first one is 104,212, greater than the end one, 100,000, right?
But also interest expense. If we see interest expense decreasing, that would be a premium.
That's right, because you also answered a question previously. Increasing is discount, decreasing is premium. So these are the features that you can decide this table is issued at a premium. Now going back to question 24, which asks a situation that issued at a premium, and then it asks about the cash paid compared to interest expense, which is basically the first column compared to the second column. Are they greater or smaller? Cash paid is greater than the interest expense. So for 24, correct answer is C. And we got it from, by looking at the table. Now, going back to 25th and 26th. The first question is, what is the annual stated interest rate on the bond? Well, we know according to the formula, this cash paid is calculated using the principal times the annual stated interest rate, right? And then we know the 100,000 is the face value in the end of here, right, on the carrying value. So it's, that's right here, times interest rate R equals 7,000, and now R equals just 7,000 divided by 100,000. Correct answer is D. Now make sure sometimes here is quite simple. We have for each date the difference is a year, so it's an annual. Well, there will be a situation when you have a biannually paying interest. So here would be December 31st, 11, and then you have a June 30th or July the 1st. And what we calculated here is just, half year's interest, and then you have to time 2 in order to get the annual interest rate, right? But that will be another situation. The next question, what is the amount of the bond premium on December 31st, 2013? Premium, December 13th, so we are asked about this one, right? Premium, so go to the last column, that would be 101,833, right? This is the carrying value. When we need to calculate the premium, we just minus the face value of the bond. So it's gonna be 1,833. So we locate the date, find the last column, carrying value. Can't show it here, but it's the carrying value minus the principal. Next question. Question 27, retires a bond, which is 40 million, when carrying value is 42 million, but the market value for the bond is 36 million. What is the entry to the record the retirement? Well, this is quite confusing because we have 3 numbers, right? Now, in order to calculate the the difference, the entry we should record should, we have 3 numbers basically. Which 2 should we use? We gotta exclude one because otherwise it's quite confusing, right? Carrying value sounds very important because it shows up in our table, remember, right? And then we retire a 40 million bond issued when, what does it mean by retire a 40 million bond? What is the 40? It is the face value. Very good. It's the face value. So the bond in the bond it says it's in total 40 millions, but the carrying value is 42 millions. That means in my table is now 42 millions, and the market value of the bond is 36 million. What does the market value of the bond mean? Now we are retiring it, so we sell it, at the market value, right? It's a fair sale. So 36 is the amount we pay in order to retire the bond, right? So the bond was valued at 42 million in my book. That means in my book it says I owe people 42 millions. But now I only pay 36 million to retire it. So I have a pretty good deal. And the difference is 6 million. So I kind of, pay less by 6 million. So it's actually a gain for us. In this logic, choice A is correct because we have a gain. And as we previously do, gain is credited, right? So credit a gain for 6 million. Now, I also will show you how to do the journal entry of it. Sure.
This is looking at a company's point of view, right?
Yes.
But if it was an investor point of view, it would have been a loss.
That's right. But in an investment point of view, you will view this as an issuer, right? This is an investment. So you would never use retire, the word retired, right? Because this is long-term liability chapter. So we are always the borrower. And in the borrower point of view, this is a gain, right? I stop it. Stop inking. This is from your textbook. So when you retire a bond, you will erase the bond payable, erase the premiums on bond payable. This is the difference between the two. And then, depending on whether these two, the net is greater than the cash or smaller than the cash, you decide whether it's a gain or a loss. So basically, it's pretty similar than we sell an equipment, right? We have the book value. This is what the 40 million number sits in here. And then you have the premiums on bonds payable. Now it's 42 minus 2 is going to be 2 on this premium. 42 minus 40. This is the difference. And then the cash here is gonna be 36, and then you decide, oh, okay, I have a good deal. So this 6 will it's gonna be a gain. On the other hand, gain will show up here instead of the loss. This is from your book, so I think that would be quite important. Stockholders' equity. We issue 1,000 share of 1 par values common stock for 20 per share, which would be the effect on the accounting equation. Correct answer is C. It will increase its asset and increase stockholders' equity. Now, basically, what happened is the journal entry is this one. So the company issues stocks, so and then in return they collect investors' money, which is cash. So cash increases, asset will also increase as well. And then on the other hand, we issue stocks, so that means we have more stockholders' equity, and then so stockholders' equity will also increases. This is pretty simple, but now that we have the common stock and then we have an additional paid-in capital, make sure that this will also just have 1,000 times $1, right, in the common stock, and then the additional is the $9 difference. No, 19, because it's $20 per share. 29. The balance sheet of the company showed the following data about the common stock. We have authorized share, outstanding shares, issued shares, and what is the number for treasury stock shares. Well, there are some of the concepts which are pretty confusing, but I think Professor Dang's slides would be quite helpful. The total big green circle is authorized share. That is, what the company can legally issue, but it may not necessarily reach the maximum limit. Left-hand side are the issued shares, which includes outstanding and treasury. On the right-hand side, these are sitting authorized shares that are not ever issued. So basically, outstanding shares plus the one that we buy back, which we call treasury shares, are the components of issued shares. So outstanding plus treasury equals total issued share. Now, the question is on treasury shares, but we have outstanding 4,300 here. And we have issued as 4,700,000. So the difference between 4,700,000 minus 4,300,000, which is 400,000, would be treasury stocks. Answer is choice D. Question 30. Oh, we have a lot of numbers. These are all on stockholders' equity section. And what amount per share was the treasury stock purchase? Well, we may use the previous big circle relation. Who knows? Let's identify the treasury stock. It's here. Treasury stock. It tells us it's in total a total of 2,000 shares, and then at cost. So we know the total value is 25,500. But wait a second. We know the total value. We know how many numbers it is. And then now the question is, at what amount per share was this purchased? Well, we divide 25,500 by 2,000. We got the number. So it's basically 25,500 divided by 2,000, which equals 12.75. One-step calculation. What was your question? So we have this one. We have this, right? The column is, I only need this row. The information here is enough. This is the number. This is the dollar sign. This is the number. So always total number divided by dollar, we got a per share cost. 31. Own stock that has been issued and then repurchased is referred to as treasury stock. Well, that's a definition question. 32. The effect of a stock split. Answer is E. None of the above is correct. And the previous is on retained earnings, contributed capital, total asset, liability account. Okay, so let's go to the slides and see why exactly none of the above is correct. For stock splits, as you see before, an investor has one stock of my company. Now it has two stocks. So it issues additional shares of the stocks so similar to stock dividends in proportion of their holdings, probably 25 or more. No accounting entry is required. Wait a second. When you says no accounting entry is required, what does it mean? That means my accounting equation A equals L plus SE is still no effect, right? Because you don't have any accounting entry, journal entry. So total asset, no effect. Total liability, no effect. Total stockholders' equity, no effect. Then I can basically rule out this one, right? Reduce total asset. Increase the balance of liability accounts. Let's see. So we also have retained earning, contributed capital is within stockholders' equity. So let's see. To keep stock market price per share within a desired trading range. Okay. So what is exactly increase, decrease? So we have common stock shares. The number of shares, of course, will increase 1 to 2, right? 1,000 now is 2,000. And the par value of the per share is 1 to 0.5. But when I times them, I get the total par value. It will still be the same. So your common stock value is unchanged. So everything is unchanged. It's just you do a different calculation. So answer is E. Make sure you memorize it. It should be as like the write-off question. You should memorize it and then save you time. Question 33. The serve up issues 1,000 of 600, 100. Go ahead.
Sorry, I'm
sure.
Going back to the other question.
Stock split? Yes.
Yeah.
Okay.
The book it says that stock dividends reduce retained earnings, but then it increases another equity account, common stock. So could the question be formed so that stockholders' equity is not changed as a net value, but the retained earnings is changed and common stock is changed?
So you are saying about stock dividends?
Yeah.
This question is on stock split.
So they're not.
Oh no. So stock dividend is a form of dividend, while stock split is usually used for the situation where you think the stock price is too high. Apple has done some stock splits when the price is like 1,000 something is splits so that increase the liquidity. You don't need to have that much amount in order to buy one share. Right, so it increased trading. It has nothing to do with giving back to your investors. Dividends is the thing. So make sure.
Thank you.
Sure. All right, going back. So you can basically design this question is on the preferred stocks because you have shares, but then you also have something like interest rate. Okay, so this one, we first issued it at the beginning of 2017. All remaining shares are common stocks, so only 1,000 are preferred stocks. It was not able to pay dividend in 2017, but plans to pay it in 2018. Now, the keyword here is cumulative. That means even though I did not pay you in 2017, the amount I owe you, the dividend I should have paid in 2017 will carry forward to 2018. And then once I have the money for dividends, I will pay you all I owe you, all right? How much of the 1,800 dividend will be paid to the preferred, and then how much will be paid to the common stocks? So the sequence, we have preferred first, and then common shareholder in the bottom, right? So we have to allocate the 1,800,000. Let's decide how much we owe the preferred stocks. We have 1,000 shares. The pen is not working. 1,000 shares. And then times 6%, and then times 2 years, right? Where are we? Okay. Sorry, I'll be quick. Times the 6%. This is annual, so I owe $60 per year. And 100 par value. Sorry, I almost forget that. So 6,000 a year, and then we need to pay 2017 plus 2018. So basically, it's 6,000 times 2 equals 12,000. This is the total amount for preferred shareholders. So answer is C. Now the keyword here is cumulative. Question?
Is the dividend always given in par value?
Oh yes, yes.
Just in case it was like $10 par value, it could be 6% of $10.
Yes, yes. It's not the current stock price. Otherwise, that would be unfair for the the preferred stocks. Yeah. Next. Both cash dividends and stock dividends. So here is the question we had with the student previously. So two types of dividends. One is cash, one is stocks. Both of them will reduce retained earnings is the correct answer. So stock dividends will not do A because there is no cash. And B is wrong for both of them because there's nothing related to liabilities in the end. And C, reduce total stockholders' equity. Well, for stock dividends, it's not true. So let's see why it's not true. This is say investors buy common stock expenditure as a return, stock price appreciation, and dividends. Journal entry for dividends. Okay, so we have 3 dates here. This is maybe there will be question on the different dates: declaration date, record, and payment. The key things here is for stock dividends slides here. So we are paying stock dividends, and the journal entry is here. I will debit retained earnings. Remember retained earnings will decrease by dividends, and then I pay it by stock. So I will increase my common stock since it's at $1 par. So there will be additional paid-in capital. So these two will be credited. Now all the 3 accounts are under stockholders' equity. So the total net of stockholders' equity account will be unchanged. So under stockholders' dividends, there is no change in stockholders' equity, but cash dividend will be because you are paying cash. So these, in the previous slides, you will see this part will be cash, while this is retained earnings. So stockholders' equity decreases, but stock dividend, there is no effect on stockholders' equity side in total. And in your textbook, page 476, you will see a comparison on these two. Well, this is stock dividend. This is stock split. Well, it's kind of slightly different from the question because the question asks cash dividend and stock dividend. But it will be a quick summary for you on the accounts here. All right. Question 35. Organized on January the 1st, 2018, the firm was authorized to issue 100,000 shares of $5 par value. During 2018, there are the following transactions. So we have 2 issuance, the first and the second, and then we report a net income. It sounds like it's asking all the accounts, and then we pay dividends. What is the ending balance of retained earnings account? Well, this is the question in the previous 3 chapters. I remember we have, for the retained earnings account alone, we have the beginning for the B, and then increases by net income, decrease by dividends, and then we got the retained earnings ending balance. Now, because the company is organized in 2018, so it will begin with 0. Net income, the third information. Pay dividend 5.0. So in the end, retained earnings should be the net of the 3. right? And answer is A. This is not from chapter 10 exactly. We have learned it before. 36, a new question. So advantages of the corporate form that has led to growth of the of this form of business ownership include all of the following except. So it asks about the features of the corporate, this form, instead of partners or sole proprietorship. In your textbook, there are the advantages. Can you see it? It may be quite dark. So limited liability is one of them in bold, right? The second one is ability to raise capital and transfer ownership. So basically, these two are the advantages, and then you go back, So A, ability to raise capital, C and D, right? So only B does not show up from your textbook. So B is the correct answer here. All right, the last chapter. We have half an hour left, right? We should be pretty good. 37. Which of the following would be a cash flow from financing activity? Okay. What do you think? The first one, cash proceeds from a sales of inventory. That's quite operating, right? That's related to everyday business. B, cash received from a sale of land. Is it investing? It's not quite operation, and it's not about financing. You don't sell land for finance your activity. So C is it? And D, interest payment for a long-term note payable. Sounds financing, is it? It's operating, thank you, it's operating. So before we talk about 38, let's do the summary. So this is from your textbook. Now, cash outflows for interest, that means interest payment, right? You pay, that means outflow. So interest payout is operating, the first row. And see, now here, inflow, collection of interest and dividends. So the tricky thing here is the dividends. Interest is quite okay. Let's talk about the easiest. No matter you are paying interest or receiving interest, so whether you are on the left-hand side or the right-hand side, it's all about operation. The tricky thing is the dividends part. When you receive dividends, according to the rule, this is about operation. But when you pay dividends, payment of dividends is under financing. So this requires some of your memorization. Think about it. Pay dividends is quite easy because we are paying our investors. So investors invest in you by financing your projects. So it's financing. Now you receive dividends. You are doing, like you are investing in another company, and that company pays you dividends. Why do you invest in it? The investment itself, of course, is investing activities, but we are not talking about the investment amount. We are talking about the dividends they pay you. You may think they pay you every year, or you are kind of, you think they have a bright future. That's why you invest in other companies, and that is the result of the investment. So you are receiving dividends quite regularly. This is operation. You think, right? You understand their business well, and then you invest in it. As a result, you got income. You got you got a good result. So receiving dividends is operation. So these are the key, most different thing that you have to memorize. Otherwise, it's pretty clear. Now 38. Let's go back. What is not a cash flow from financing activity? Well, we just explained it. Collection of a cash dividend. Collection is operating. So C is not the correct one. All the rest are financing activities if you check the table. 39. The company reported a selling equipment of 222 million and purchased a 1,550 million of new equipment. So there is a sale and there is a purchase. The equipment sold has a net book value of 150 million. Cash flow from investing activity will show, oh, okay. So first of all, looking at the choices, there is a separated one and a combined one, right? You have an inflow-outflow format or a net format. Which format do we go? Like, which format are we using? Think about the previous chart I showed you. Is it a net format or is it like a separate inflow-outflow format? Separate. So basically, we ruled out C and D now. So A and B, the difference is the, is the numbers. Why do we have a 150 and, so outflow is pretty clear. It's 1515, right? That's the same. And then now it's the key on difference of between A and B is this one. It's on the report that they sold for 222. Oh, okay. So then the equipment sold had a net book value of 150. So now it boils down to, should we record the 150 or should we record the 222? Reason?
The depreciation is added in the operating activities, so you have to show actual cost of the equipment, not the net cost.
Okay, I kind of follow you. Because the journal entry, when we sold the equipment, what do I debit for cash? I will do debit cash for 222 million, right? And then I will, credit the book value of 150, and the difference would be a gain or something. Now we are talking about cash flow, right? So of course, this is what I debit to my cash. So cash flow should, only related to the 222 one, right? So, well, the other way you should think about it, we are talking about cash. So which one is the actual cash? It's never the 150, so it's the 222. Question?
Net outflow.
Oh, that's because the format we show. Remember, the way we do cash flow. Go ahead.
Will you credit equipment 2 as well?
Equipment 2?
When you said debit cash 22 million, and credit book value?
Yes.
Equipment 2, right?
Equipment.
You will credit equipment because you don't have that anymore.
Yes, sorry, I said I write book. It's actually equipment. Equipment book value. What am I writing? And the reason it's not a net flow is if you look at a actual cash flow statement, you will see there is an inflow and then there is outflow, and in the end there is a net. So you will have a different display for the two first. So it's not like a very general account. But I don't have it with me, so I can't show you right now, but you can check the book. Question 40. The corporation had the following transaction during 2016. 1, 2, 3, 4, 5, 7. So let's see. The question asks, what is the net cash provided by operating invest activities? So first to decide which activities are operating, and then we calculate the net cash, right? Let's do it together. Issue common stock is a financing activity, right? So I'll write down a finance. Number 2, recorded and paid wages expense. Wages is operating. So this is an operation, and then it's a minus, right? We pay. And then we declared and paid a cash dividend for 10,000. Is it financing or operating? Finance, thank you. Number 4, sold a long-term investment for cash of 3,000. Investing, very good. Recorded cash sales for 400,000. Well, that is, right? Yes. Operating, and this is a sale, so it will increase our cash. Number 6, bought inventory for cash of 160. Operating, very good. And then we have a cash outflow, right? Because we sell, we paid. The last one, acquired an investment in the stock, another company's stocks for cash. This is investing. You have the word investment here. So only number 2, number 5, and number 6 are related to operation. And then now we need to calculate the net cash. The first one is paying wage expense, so it's a negative 60,000 outflow, negative means. And then number 5 is cash sales, so it's an increase of 400,000. Number 6 is buying inventory but paying cash, so it's a minus 160. So it's 2, 5, and 6, and the net is 180. Right? Remember the way I do it, right? Maybe when you first design it, you also think about plus or minus. Question 41, we had a net income of 242, depreciation expense. Okay, we have a lot of accounts here. How much cash was paid by operating activities? This is asking for the indirect method, right? We start from net income. So whenever you see net income and then you see cash provided by operating activities, this is the indirect method. And there is a list of the accounts that we need to add back and need to subtract from the net income, right? The basic logic is that there are just so many transactions that we cannot, use human labor to figure out how much cash in operation. So we start from net income. Net income is on the accrual side. Now we are calculating the cash. So we, we list out all the items in the income statement, identify it one by one, which is non-cash or which is over-calculated, subtracted out, which haven't been figured out, we put it back. So this is the adjustment. And it's 1, 2, 3, 4, 5, 6, 7, 8. Basically, it's actually 4 big categories. You see gain and loss, right, plus minus. And then this is on depreciation, amortization. One is tangible, one is intangible. And then current assets, current liability. Let's take depreciation as an example. We subtracted it to get net income, right? Net income does not include depreciation. It's actually used revenue minus depreciation, right, and expense. But depreciation is a non-cash item. That means it's artificially put subtractive to get the net income. So in order to transit from net income to cash, we need to add it back. So this non-cash item should be added back on top of the net income. Loss on sale, gain on sale, loss on sale. We have taken this into consideration, but this is not operating because selling an asset is an investment activity. So it's not from operating. That's why we need to subtract it, right? Before it's a loss, then we minus it. Now we add it back, so it's an operate side or opposite side. Current asset, current liability. Think about, let's use an example. What example would be the best? Think about, actually I would want to say account receivable, but I think that would be pretty weird. I kind of cannot think of a good example here. Inventory. The increase in inventory, I'm not sure. Maybe. How do you think of this one? If this is an inventory, and then in the inventory, let's use accounts receivable. Now this is an increase in current asset. Account receivable is an current asset. If I have an increase in account receivable, as last time, I know credit sales will increase my account receivable, right? Instead of cash, I put it in account receivable. Account receivable means when I sell something to my clients, but I haven't received cash back, I will put it in my accounts receivable. Now, during the year, I have an increase in my current asset, in my account receivable. That means, I have more on-account items that my clients have, owe us and haven't paid me, right? So these that means an increase. But when I think about the net income calculation, whenever I sell something, I already record a revenue, right? But actually, I haven't received the cash because it's sitting in my account receivable item. So I need to subtract it because I haven't actually received that much cash. So I subtract the increase of current liability, current account receivable. So I will be. This is the hardest part. I admit. So let's make a simple example. Beginning balance. For example, I have 100. Now I have a 50 during the year, and ending balance of account receivable means 150. How do I do this 50 for journal entry? I would debit account receivable. The counterparty is no supplies revenue. The 50 happens when I sell a $50 item to my clients, and I sell it on account. Then I will credit revenue, and then I will debit my accounts receivable. And now there is an increase of 50 in my current asset. Now I'm thinking about the 50. The 50 goes to revenue, and then in the end, it will go to my net income, right? Revenue minus all the expenses is net income. But now that we think about the transaction of the 50, it does not have any cash component on it because it's on account. I haven't actually received the $50. So when I calculate the cash flow from operation, I cannot put the 50 there. So I need to subtract it back. So then subtract 50, so minus the increase in accounts in current assets. So this is kind of like the logic, and I know it's very hard. If you see, it takes me a while to make it straight. But this is how it goes, and you can also find another one for current liability from the textbook. Anyway, so for the interest of time, usually this is how I do it for the calculation. Now I summarize it into this formula. It's maybe kind of easier for us, so let's try. I still start from net income NI, and then I will always plus the depreciation, of course slash amortization, but for save space, non-cash item, right? And then I minus the change of current asset. How do I do it? If change in current asset is positive, that means it is an increase. The sign is a minus, so it goes well. If the change in current asset is a negative component, that is decrease, right? So it's a decrease here. And then if it is a negative, so inside it is a negative, and then outside is another negative, so it means it's positive. That means it's adding the decrease. So it also consigns. So basically, I kind of summarize these two into minus the change of current asset, plus the change of current liability, same thing, just the formula-wise. And then minus gain plus losses. Let's try it out. I know it's hard, but let's write it down. Let's do it. This is, I think, personally, the hardest for cash flow. But once you memorize it, you basically overcome the hardest part of the whole chapter. So we start with, remember, this is it, and then plus depreciation minus the change in current asset plus the change in current liability plus loss minus gains. Now we start with the net income, which is 242. I will erase the 3 digits now. And then depreciation expense is 26. So plus it back. Now, why do I do that? Now it's the current asset. So I put the minus here, and then the parenthesis is to calculate the change. Accounts receivable, inventory, both are current assets, and they have increased for these two numbers. So it's a plus 15 and a plus 40. Prepaid expense. Wait a second. Prepaid expenses, is it a current liability or current asset? Asset is actually an asset. I have prepaid, right? Almost forget about it. So prepaid expenses decreased by 2,000. So a decrease by 2,000 for prepaid. And the last one is accounts payable. This is a current liability, so I am safe to close the parenthesis for current asset. And then here is a minus. Here is a plus. Inside is the accounts payable decrease, so it's a minus 14, right? What else? Okay, so current liability has only one item. There was also a loss on sale, so loss should be plus back, plus 17. So I boil it down to this equation. Now the reason I use it because it's really confusing for a decrease, increase, and then you also need to remember the sign. That's why I use a delta, a change, so that inside the parentheses I start to consider the second layer. So now that I have this one, all I need to do is make sure my calculation is correct, because it's still quite an effort to make sure it's correct. Sometimes I also did it wrong in this step. So 242 plus 26, this is 55 minus 2, so it's minus 53, minus 14 plus 17. Well, you have your calculation, your calculator in it, so once you make sure the signs are correct, there should be no problem to get choice A. Any question on this one? So I think the key here is to find a good formula to memorize, and then practice quite a bit to make sure that you understand every step and be familiar with it. And also prepay different expenses, sometimes unearned revenue. Those are easy confusion, so make sure you also understand what account is current asset or liabilities. Can you say that again? Yes, prepaid expense is an asset, no question, right? How about deferred revenue? Liability is a current liability, so it will be plus the change. Question 42. Which of the following would be added to net income when determining cash flows from operating activities under indirect method? So now it's added back, right? Going back to the formula, okay, what will we add it back? We have this one, minus the change plus the change of current liability minus gain plus losses. So let me rewrite it back so that everybody can follow me. This is loss. The reason I need to write it because there's also a decrease, and then you have to consider the formula's number. So choice A, okay, a decrease in accounts payable. Accounts payable is a liability, so it will be here. So basically it's a plus and then delta CL, right? Plus, inside the change, there is a decrease. So 1 plus 1 minus is a minus, so it doesn't count as an increase. So it's not added back. B, amortization expense is pretty easy, right? Once you have this one, so it's added back. An increase in prepaid insurance. Prepay, we just discussed, is a current asset. So it's a minus the change. The change inside the parenthesis is an increase. So minus plus, so it's a minus, not true as well. A gain on sale, it should be subtracted. So only B is correct. But if the question would be harder, erase the B, erase the amortization, and you have to figure out the parenthesis outside parenthesis. That would be really asking you whether you understand the calculation. 43, operating cash flow exclude, well, this is the definition, right? Dividend paid. Dividend paid is financing. Very good. 44, which of the following statement is true? Correct answer is C. Let's look at it first. Losses on sale of long-term assets are an adjustment reported in operating activities section of the stockholder statement of cash flow under the indirect method. That's right? We have, under the indirect method, we did have the loss on sale. We need to plus it back, right? Let's see what are the wrong answers here. A investment in another company's common stock is classified as cash flow from financing. Wait a second. Investment, you just say the first word investment. It should be investing activities. B, repayment of long-term debt is classified as cash outflow of investing. Wait, you repay, so you are the borrower. When you borrow money, is financing activities, so not investing. D, dividends paid are classified as cash outflows from operating activities. Is it true? No, it's financing. Didn't you just ask, right? 43 and 44, basically for the same thing. The last one. The following information pertains to this alpha computing at the end of 2018. We have asset, liability, net income, common stock. Okay, retained earnings account had a zero balance at the beginning of 2018. What amounts of dividends did the company pay in 2018? How do I calculate it? Why do I need assets, liabilities? Very good. From these two, we get the stockholders' equity, right? From asset equals liability plus stockholders' equity. Now, with the stockholders' equity, what can we do? We have common stocks, we have stockholders' equity. So it's basically asking us, what is the, position for retained earnings in the expanded accounting equation. So remember this one. And under stockholders' equity, we have common stocks, we have retained earnings. And retained earnings, we say net income increases retained earnings, dividends decrease retained earnings, right? So now we get stockholders' equity. Mind you that this is at the end of the year. So whatever we calculate for retained earnings is the ending balance of retained earnings. So we have 970 here, 560 for liabilities, so that we have stockholders' equity, according to the answer, is 410. Now we have a stockholders' equity number, and then we have the common stock, 350, which is here. So 410 equals 350 plus retained earnings. This is the end of 2018. So retained earnings ending balance is 410 minus 350 is 60,000, right? Now I have retained earnings ending balance, right? Remember again, we are calculating at the end of 2018. All the numbers are at the end of 2018. Beginning balance for retained earnings is 0. Again, we talked about this before. Beginning balance, which is 0, plus net income minus dividends equals retained earnings ending balance. Now ending balance, we just calculated using the other three accounts. Net income here, 90. All right, so we basically can get our dividends, right? 90 minus 60 equals dividends. So dividends is 30,000. The last question asks us, all the related information of retained earnings. Where is it in the expanded accounting equation? What's the relationship between retained earnings and common stock and stockholders' equity and every other big categories? And then our, quite familiar old friend, this old equation that we have always used. Now that we have everything, we got one of the either net income or the dividends. All right, I hope you have a good 2 hours. Good luck with your final.